let's quickly move on and look at the next set of major earnings that came in, of course. Yesterday, HCLTech reported a strong second quarter. Revenue beat estimates and the margin expanded 150 basis points on a sequential basis. The company also raised the lower end of its full-year guidance from 3 to 3.5%. My colleague Rima caught up with C. Vijay Kumar, CEO and Managing Director, as well as Shiv Walia, Chief Financial Officer of the company, and began by asking where the margin beat, where the beat came from this quarter, and which verticals and geographies have been performing the best. Take a look.
So overall, across the board, we found the growth picking up in the last quarter. So financial services definitely had a strong performance, adjusted for the divestment that we had. And across the board, whether it is retail CPG or tech and services, life sciences and healthcare, these were the top three verticals in addition to financial services, where we saw incremental revenue, which helped us do better than our own expectations.
CVK, you're still cautious about extrapolating the strong Q2 demand. Why is that?
Yes, I think today we just need to be a little cautious because the demand has been very volatile. Like in calendar year 2022, November, December is when we got signals of serious weakness in the spend environment for the clients. And of course, we are remaining cognizant of the broader macro and geopolitical environment and being cautious that we don't want to extrapolate it. We've done well. That's why we've increased the lower end of the guidance. And we need to give it some more time before taking a strong view on the overall demand environment.
But do you think the environment currently we're in is similar to November and December of 2022, which is when demand weakness crept in? Are you seeing any likeness in the environment?
No, the demand environment is significantly better than what we saw in the last quarter. But the reason that we are not extrapolating this to the future is based on the experience that we and everybody in the industry saw in 2022.
Okay. Shiv, I believe you've called out the impact of the wage hikes, the impact of the wage hikes on margins for Q3 and Q4. So can you tell us that? So with that, do you think you're likely to end closer to the lower end or the upper end of your margin guidance of 18 to 19%?
So yes, we have called out the wage hike impact is going to be 60 to 85 basis point in Q3, and maybe another 50 to 60 basis point in Q4. But Riva, in terms of, I don't think it's going to make any impact. It's part of the planned wage revision we have done, and our margin guidance are still intact, 18 to 19% quarter on quarter, year on year. I think we are confident of achieving that. But I would not like to call out low end or high end because this is a planned wage revision we have done for this year.
CVK, what's the outlook? Some more color on BFSI, because BFSI X of the divestment grew 4% on a quarter-on-quarter basis. Green shoots in BFSI is something that we've heard from across, IT players. Are you at least confident about BFSI demand sustaining going forward? What's the momentum like?
I think BFSI North America picking up is something we had called out in August itself. And now I would say that the demand is a little more broad-based in the financial services. We found very strong growth coming in from Asia Pac, which is our growth markets. Europe as well grew quite well in the last quarter. And in the US, especially insurance, definitely grew well. So I think it's a little more broad-based and we feel good. And it's really what's happening is there's a lot of modernization programs where clients were a little cautious, but with Gen AI also giving a lot of promise on what can be done in modernization, we see some of those programs really taking off.
And what's the outlook on the other sectors? Are there any spots any verticals where you're still a bit cautious?
It's really micro verticals. Maybe I think auto in some segments, like for example, Europe automotive segment is under some pressure. There are specific clients in aerospace where there is definitely some pressure. But all of this goes into manufacturing. But manufacturing demand is also accentuated by a lot of SAP migrations that you see in the traditional manufacturing companies. So that's definitely offsetting some of the demand softness and some of the challenges that we are seeing in specific clients.
Would you say the discretionary demand is back to some extent?
Sorry, what was that question?
Would you say the discretionary demand is back, to some extent? Earlier, it was all about cost optimization, efficiency.
Yeah, definitely. So this quarter, the growth was fairly balanced. If you look at our ITBS, it's grown about 1.8% sequentially. And adjusting for the divestment, it's probably closer to a 3% growth. What does this mean? I mean, maybe 2.5% growth. And this 2.5% is quite well balanced between efficiency-led programs, which we had won, which are getting ramped up in the last quarter, and incremental demand coming from a lot of existing customers, which are mostly discretionary in nature. They're largely around data and AI is the biggest theme, and compliance and programs on modernization and things like that. Those are the discretionary aspects which we are seeing pick up now.
Shiv, what's the outlook on hiring? Your net employee base contracted for the second consecutive quarter. And even on attrition, will it stay stable for the next 2 quarters, according to you?
Starting with the first question, on the hiring front, on the contraction of workforce, I think if you see if you take out the divestment-linked State Street divestment, so on the year-on-year basis, our workforce has increased by around 2.4%. And we have, last year, we hired around 12,000 freshers, despite the fact that industry hiring was muted. And as we announced in August, we have a Ascent program kicking in now, which we intend to have Gen AI-led productivity and efficiency improvements. That will help us to, gain some more productivity and utilization. As well as I think we are going to have AI-led program to reskill and train our employees. So that will also give us the leverage required to meet the demand. So we have not worked out. We do intend to hire additional maybe 2,000 freshers this year. But that's it, I guess. We don't expect for the next year. We have to plan out the fresher hiring, work out the plan on this.
CVK, is it possible to quantify what the AI or Gen AI pipeline is?
I think, I think it's kind of a misnomer to kind of look at Gen AI pipeline, because a lot of pipeline is dependent on what programs Gen AI can enable an enterprise. So, of course, the modernization, there is a lot of modernization programs which are becoming viable, and customers are focused on eliminating technical debt, where they're using Gen AI as a very important tool. So I think that pipeline is quite strong. The second aspect is to get the right leverage out of Gen AI. Data is a very important underlying ingredient. And so a lot of work on streamlining data pipelines, all of that is where we see demand. And the third element is as customers are looking at scaling Gen AI, the underlying infrastructure, whether it is the hyperscaler or private AI stack, both of them are being used in different scenarios. So I think these are the 3 broad elements: modernization, data and AI, and cognitive infrastructure. All the 3 are the manifestations of Gen AI programs.
One final question then. How are the decision-making cycles? Have we seen a pickup? And is it realistic to expect a pickup in budgets next year because of the interest rate cutting cycle in the US, a potential thaw once the US elections are out of the way in decision-making?
Yeah, it's a little early to call that, Rima, but given what we saw in this quarter, and if you want to remain optimistic, I think it should pick up a little bit. But at this point, we have not baked in some of that. We really are focused on executing the current demand that's on hand, and being a little bit cautious about the broader macro environment and some specific client issues. So we'll wait for this quarter before taking a call on the longer-term trend.
And do you think you'll end at the lower end or the upper end of the revenue guidance based on the visibility that you have right now?
Right now, it's 3.5% to 5%. That's a range that we've given, and that translates to 0 to 2% on a quarterly run rate. So I think we're comfortable. We're not trying to be more precise than that.
Okay, the demand environment is getting better, but HCLTech remains cautious given the macro setup.